Welcome to the Passive Income Podcast. I'm your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. And joining me today, Jeremy. Welcome back, Jeremy. It's been over a year since you've been here on the Passive Income Podcast. How have you been?
Awesome. I've been great. Thank you. Thank you for having me back, Dave. Really appreciate it. Yeah, things have been good. Just grinding away at our dividend portfolio and making things happen. So happy to be back. Happy to be talking to you. Looking forward to this.
Yeah, awesome, awesome. So, like I mentioned, it's been over a year. It was episode 36 that you were on, and we are now up to, I believe, episode 134. So, so many episodes and guests that I've talked to in between. And I'm just kind of wondering what has changed, what has stayed the same. I know when we spoke last time, dividend stockpile, I was like, wow, you literally do have a stockpile of so many different positions. And I guess I'm just first curious, do you still have that stockpile or what's going on there?
Yeah, so I absolutely do. So a lot of people ask me why I have so many holdings, and I find it is really about the stability of the income itself and the dividends. I've always said if you have 20 holdings and one cuts, you lose 5% of your income. But if you have 50 holdings and one cuts, you only lose 2%. And so that 2% is a lot easier to manage and to come back from than a 5 or maybe even 10% cut if you have a
Right.
very concentrated portfolio. So I'm always going to have a very diverse portfolio because I need that income stability. If I was a growth investor, I would be more concentrated, really pick my investments to have the highest growth, and then I might be willing to do 15 to 20 holdings. That being said, I am focused mostly on ETFs going forward and closed-end funds as well, CEFs. Those are definitely the areas I'm pushing for, and I want it to be about 65% of my portfolio and ETFs and closed-end funds. So in 2024, that's what I'm focusing on. I'm only putting new money in to ETFs and closed-end funds.
Right, so you're just like, "I've allocated this amount of funds to it, and I'm not gonna, add any touch them," and I can relate to this too. It's like, "You know what? That dividend keeps rolling in, so why mess with it?" Kind of is that sort of the idea?
Yeah, that's exactly it. So I have cut a few positions just because I didn't see the growth or the conviction in those names anymore. But generally speaking, in my portfolio, the existing holdings that I've had for years and years, I just let sit there and do their thing. Some of those I've turned off the dividend drip, and now I'm just reallocating that money elsewhere as it comes in. Other ones I'm just letting it
Right.
drip and add more shares over time, and I'm not going to think about it. But each of my individual holdings, the majority are under 1% of my portfolio. There's a few that are around 2%, but I'm really trying to go away from the individual holdings being the primary focus and pushing more towards the ETFs. So yeah, so the
Right, right,
existing ones
so
are they're still sitting there, but I'm not really doing much with them. There's an occasional one that I'll add a $50 here, $100 there, just to if the market tanks or something like that. But it's definitely not the priority anymore.
right. So you're consolidating a little bit, selling off a few positions, but for the most part, I just like I said, just setting them into the background and more or less forgetting about them, and I like that idea too, personally. I've never used automatic drip. I like to have the cash come into my sit there in the brokerage account, and then I can dollar cost average down on other positions. I'm kinda guessing that's sort of your similar strategy?
Yeah, for the vast majority, I would say, I probably have between 40 and 50 individual stocks. And of those, maybe 10 to 15 are set for drip. All the rest are just put in cash, and I use the money for other things.
Right, right, right. I am gonna quickly give a, ad read here to, Millionaire Mentorship. A very special thank you to Millionaire Mentorship for sponsoring this episode of the Passive Income Podcast. Millionaire Mentorship with Abundantly Erica will teach you everything you need to know about options trading, from covered calls to cash secured puts and everything else involved in options trading. Millionaire Mentorship has you covered. Use the link in the description below to get started today. Now, I know you are into options trading as well, and I've had many guests, including Erica, options trader Chris, Leah the trader, covered calls Barbie, and I've definitely begun learning the terms like cash secured puts and covered calls and strike and premium, but I still really do not understand it.
Hmm.
So I guess just dive in there to what got you into options trading, what the advantages are, and anything you really wanna say about options.
Okay, sure. Just a little plug to Erica. Erica's great. I follow her on X as well, and she always puts out great content. I'm sure her mentorship will help anyone who joins, really understand how to do options trading. I also follow, I think, all the other names of the people you mentioned that you had on the podcast. I follow them on X as well. So it's a good group. So if you are interested in option trading, those are definitely some of the ones to follow. So for option trading for myself, it's really all about income generation for me. Generally speaking, I only sell options. I don't buy options. And being the seller of option makes you more like the casino instead of the gambler, or in another analogy, as the insurance company instead of the insured. So think of it as, someone is going to get car insurance. They're going to pay a premium up front at the beginning of their term in order to be protected. And options trading is just the same way. As the option seller, you're giving someone else coverage to do something with their shares, either buy or sell. And for that obligation that you're setting up, you get paid a cash premium up front. If something happens, i.e., the stock goes up or down and goes over the contract threshold, then you're obligated as the seller to fulfill that contract. Just like if you're the car insurance company and something happened, you're obligated to fulfill that contract. The same thing, but if nothing happens during that term, I keep all the premium I receive, just like your car insurance. And in order to have that contract again, the buyer has to pay me more premium, just like a car. So that's the approach that I take. I'm the seller, not the buyer. It provides a more stable income source. Personally, I shoot for a return of about 0.5% a week on my options trades. So my year-end goal is about 24%. So I give myself a little bit of flexibility, but 24% is my goal for option selling.
Wow, yeah, so that actually provides, like you said, I think, and I'm sure that's why everyone else would be into it too, is for that added income, right?
Hmm.
Like, we're not in the stock market to lose money, although we do that sometimes too,
Sure.
but the whole goal is to, over time, uh, increase your wealth, right?
Absolutely. Yeah, so I was able to produce, a mid five-digit revenue or income source from options last year. So it was very substantial part of my income portfolio, and allowed me to reinvest those funds into more options trades as well as more dividend stocks. So it's definitely been a game changer for me. I've been doing options. This is my 5th year doing options, and it's definitely going really well so far.
Yeah, wow. So, it definitely is something I need to learn more about. Now, I guess the other part that I do know is also you need a lot of 100 shares of a company, which also can be, depending on what stock it is. Like if you're selling options on Apple or Tesla, those are, say, $200 stocks. I'm not sure exactly where they're trading at, but
Hmm.
you know, you're up to, what is that, $20,000 right off the hop,
Yep.
right?
Yeah, so obviously, you want to find a stable and profitable company to do your options trades on. You don't want to do the YOLO type of plays where the company could go bankrupt next month, or the stock is going up and down 20% every single week. So you definitely want to stay away from the riskier companies, but there are some good names that you can choose on the lower end of the price range. One that's been really hot lately is Mara, Mara. It has to do with cryptocurrency. SoFi, the online bank, if you will, is definitely been a popular one. That's under $10 a share. Um, Tesla, TSLL is a 1.5 times Tesla stock. So that's a good one. That's only a small dollar amount. I think it's around $12 or so. So there's plenty of investments that you can do options on that aren't those high dollar amounts, like the Googles, like the Apples, Microsoft, things like that. That would take a lot of money for sure. But there's a lot of individual companies
Yeah. So
and ETFs in the, say, $20 to $40 per share range, which are much more accessible.
yeah, yeah, exactly. Like, that one's a share times 100, you're at $1,200, which is obviously,
Hmm.
a lot easier to cut to, get your hands on $1,200 than 20,000. Don't get me wrong, it's still $1,200, but
Yeah, yeah.
um, that
No,
is
it
obviously a huge difference, right?
Yeah, it definitely takes some money to get started. You don't have to have hundreds of thousands of dollars, but you do need, I would say probably 5,000 would be a realistic starting point so that you're properly diversified. You're going to want a couple trades. You don't want to put all that 5,000 into one trade just in case something crazy goes on and, stock goes down 50% or something like that. You're going to get stuck with it. But you can spread it out over a couple. And as you're
Right.
collecting that premium and adding more money on your own, you can start getting to the, $10,000 trades and then $50,000 trades and so on and so on. You can just build up from there. When I first started my very first option trade, the premium I received was like $8. Like it, it was a very small start. I was testing the waters to try and figure it out. But then, over the years, I've increased it where now I'm bringing in, sometimes $2,000 a week in premiums from my options trades. Just
Wow.
because one, I built up my balances, and two, I'm more comfortable with what I'm doing now, so I'm willing to put in more trades now.
Yeah, so I think that's a great point too, is like anything else, there's a learning curve to it, and
Hmm.
you probably should start out small as you're learning and be happy with that first $8 and not try to go for the 2 grand right off the hop.
Absolutely. Until one, how options work, how the contracts work, what are the different variables that could happen at the end of the contract, you really need to take it small and learn. And then as you start getting more comfortable, and it doesn't take a very long time, I would say within a couple months of doing consistent trades, you get a good feeling of the logistics of how to do it. Then it's just a matter of finding the right companies to do it on, the ones you're comfortable with.
Right. Right, interesting. Before we move along, sort of anything else you wanna say to kinda wrap up the picture, the idea of options trading?
Yeah, so options is really just, establishing where you're using the funds you already have in your account, whether it's 100 shares of a stock or the cash in order to purchase 100 shares of a stock, and you're using that available resource to pump up your income. So let's just say you own Coca-Cola and you're getting a 3.5% dividend by doing a very simple low risk type of strategy and options, you could add another 12% in options premium per year. So that is money in your account that you can use the minute you write the contract to either live off of or reinvest to other things. So instead of just getting 3% on a stock like Coca-Cola, you could easily get 15% a year just by establishing a very simple, very straightforward, very risk averse option strategy. So it's definitely something all income investors should look into. It's not for everyone because it does require some extra work, either on a weekly or monthly basis. But the returns that you can get through income generation is definitely worth the time to at least look into it.
Right, so you would call it, like, semi-passive. It's not completely passive the way dividends are, but, somewhat passive because 'cause you're not working 40 hours a week at it, but you're probably working maybe 5 or 10 hours a week at it or something like that.
Yeah, probably not. I mean, maybe at the very beginning, when you're trying to learn everything, but after you kind of get a sense on which stocks you like doing the trades on, for my typical week, I spend between 30 minutes and an hour doing my trades. Usually on Mondays, if the market is
Right.
different, I might add a couple other days in there. But yeah, it's usually not too much work once you get going at it.
Okay, awesome, awesome. I definitely do need to learn more about options trading, and Erica has definitely said she's going to help me with that, but I just haven't, got into the learning process of it yet, but, definitely something that I know I need to do to, like you said, help generate more income.
Yeah.
Moving along sort of to, well, again, your name, Dividend Stockpile, on Twitter
Hmm.
at Div Stockpile. Um, and I did also mention to you before we started recording that I just recently watched the Newcomer Investor episode with you and Anthony. And so here's the thing: I don't want to just rehash everything you and Anthony talked about, but obviously there's going to be some crossover. So you, as an American, invest in several Canadian companies, Canadian stocks, and I guess how did you first look at the Canadian market, and then why did you? Because Anthony had a great point. Like, there's so many great companies in the U.S. that you have to choose from. Like, the list is just endless. So why Canada?
Hmm. Yeah, sure. So when you're an investor and when you're looking for income, you're looking for the best opportunities that are out there. And Canadian stocks are known for their dividends. There's your banks have been around for hundreds of years. They've been paying dividends for hundreds of years. They are very consistent and stable. Look back at the great financial crisis of 2008 and 2009. most of the U.S. banks had to cut their dividend, or honestly went out of business during that time. But Canadian banks just kept chugging along. So
Yeah, they weathered
the
the storm.
exactly, and they have better risk management programs in place, and more conservative underwriting when it comes to the loans that they do and things like that. So, as an income investor, one of the main things you're looking for is that stability and consistency. And so, Canadian companies generally have been more consistent, more established names. And so, I look throughout the world, and Canada is one that has great dividend policies. So for Canadian companies, I have TD Bank, I have Bell Canada. I love the Brookfield names. So I have BAM, BAM. I have BEP, the renewable energy portion of Brookfield. I have BIP, the Infrastructure Partners Program. I used to have BN, which is the main corporate Brookfield, but I've since consolidated that into BAM. And so I'm always looking for opportunities wherever I can find them. And because of the tax treaty between Canada and the United States, it doesn't cost me any more to invest in Canadian companies because the tax is balanced out. So I might as well find, the best companies that I can find.
Right, right. So before we get into the Brookfield between you and Anthony, 'cause I know Anthony loves Brookfield as well, and it's high on my watch list as well. I just haven't pulled the
Yeah.
trigger on that one. And that kind of goes back to having too many positions. Um, First, I guess I want to talk about TD because, as you mentioned, the Canadian
hmm
banks paying dividends. Actually, Bank of Montreal is this year is on the 195th anniversary of paying dividends, so nearly 200 years. Bank
hmm
of Nova Scotia, I believe, since 1833, so 9 years away from its 200th anniversary. TD is somewhere in the 1850s, I believe, when they started paying a dividend. CIBC is there, Royal Bank. I guess why did you come to TD and not any of the other big 5 that I just mentioned?
Okay. Good. I think the main thing for me is I'm more aware of TD down here in the United States. Has more of a
Right.
presence. So one of my previous jobs, I was in banking for a vast majority of my career, ever since I got out of college until about 15 years ago. And so I competed against, TD Bank and other banks like that. And, you always had that exposure and that understanding of how good of a company TD is. Another one that's big down here is BMO. They bought
Yeah.
another local bank, recently, in the last few years at least, down here in the United States. And so they're becoming more popular, but it was really just, brand awareness and understanding of the name is why I chose TD. At some points, I did own BMO and BNS and some of the other ones, but I've since consolidated.
Yeah, fair enough, fair enough. Yeah, definitely, there is more, like just even Toronto Dominion branches in the U.S.
hmm
And you look at, I believe it's in Boston, the TD Ameritrade Gardens. So you
hmm
like huge brand awareness there when you see a stadium name sponsorship. So yeah, I definitely understand that. Now, you also mentioned BCE, Bell
hmm
Canada, and full disclosure, most people know that I've been chipping away at adding to my position in Bell Canada over the last year and a few months, last 14 or 16 months. So I guess I'm sure you're also aware of TELUS and Rogers, the other two big telecoms here in Canada. Uh, what was the decision making factor there in Bell versus the other telecoms?
Yeah, so I definitely looked at TELUS because I know a lot of people really like that one. I don't remember the exact reason why it was Bell over TELUS, but I just remember looking at the metrics, and I felt more comfortable with BCE than I did for TELUS. That was really what it came down to. Here in the United States, our telecoms are pretty junky, to be honest. You have AT&T and T and Verizon, which they have a storied history, but if you look at their growth and their dividend policies and things like that, it really hasn't been anything to be too happy with. So in order to fill up the communications bucket of my portfolio, I was looking for things outside that made more sense than BCE. Just seemed like a better stability and better quality company when it comes to the telecom space.
Right.
My other one in that space is CCOI, which a lot of people haven't really heard, is Cogent Communications. So those are the two main focuses on my telecom or communications bucket, if you will.
Right. And then so that second one is an
It is, yep.
American
hmm
company.
Yeah, it pays a really good dividend. It has really good
Right.
dividend growth. It's not a very popular name, but it has performed really well, so definitely worth checking out.
Okay, okay. Before we get into Brookfield, because I know we'll talk about that a lot. So TD, Bell, are there any other positions from Canada that you have
Um,
other
it,
than Brookfield?
yeah, so this is where it gets hard with so many holdings. Sometimes I forget some of the maybe smaller names I have, but I think that those are the ones, TD, BCE, and then the Brookfield companies.
Okay,
Yeah,
okay, fair enough. Because again, there's obviously there's a lot of great companies in Canada too. There's tons of companies listed on the TSX that are also traded on in New York. So that also makes it easier for American investors just to buy them in New York in U.S. dollars and
yeah, yeah.
right. Like I'm sure that's what you
Definitely,
do,
yeah,
right?
all on the New York Stock Exchange. I used to own Canadian National a little while back, um, but it was back when they were trying to buy out I forget the name of the American railway that they were bidding. There we
Kansas
go.
City,
I
Kansas
Yep,
City
yep.
Southern,
There you go. So I was in it before that, and then when they lost that bid to the other Canadian, there we
CP,
go. Man,
Canadian
I can't
Pacific.
think of these. Yes, Canadian Pacific. I decided to go and get out of CN at that point. That was definitely one that I've held in the past. Oh, and what I was going to say is I don't own any energy companies. So I don't own any oil or gas or pipeline or anything like that. And so that takes a big chunk of the Canadian market away from what I'd be interested in. And so that's I really
Right,
haven't done anything like Canadian National Resources or any of that. I just have stayed away from them.
right, right. Well, at some point in the next 10 or 15 minutes, there will be a Canadian National train going by right at the window there, so I will let you and everyone else know when it passes by because they go by all day, every day, as I'm sure you've seen my posts on
Yeah,
Twitter about
yeah,
that.
yeah, for sure. And again, it's totally great company, a storied history, well protected. It's a great company. Just for what I was looking for, it wasn't the right fit anymore.
We've mentioned that many times here on the Passive Income Podcast. Definitely, the railways have the probably the best moats because nobody's coming along and building a new railroad track anytime soon, right? Or maybe they're
Yeah,
building them, but it's CN and CP who are building any new
exactly.
tracks that might be going in somewhere. There's not another company coming along and say, "I'm gonna build another railway from coast to coast." Just not
Yeah.
happening, right?
Definitely
So
not going to happen. So just here locally, I live in Florida, down in the United States, and we are trying to get a commuter rail built out between the major cities down here. And just the amount of money and the amount of time that's taken for them just to find the track space and the right of way for just a small railway, not even a freight railway like CN and CP are, even that alone has been a disaster for the last 15, 20 years. So, and that's just in the backwoods of Florida, much less major metropolitan areas are cutting through major developments. So to build out a nationwide railroad is just not going to happen anymore.
yeah, in neither Canada nor the US nor
Yeah,
Mexico or probably most places around the world at this point, the railway networks are built for the most part,
precisely.
right?
Yep.
And then let's get into the whole Brookfield
Hmm.
ecosystem because at the top there's if I'm not mistaken, BAM, Brookfield Asset Management, and then it breaks down into like the renewables
Yeah.
and you and Anthony definitely know more about Brookfield than I do, so I'm just going to let you jump in and take
Sure.
over.
So Brookfield is huge. It's worldwide. It has tentacles everywhere, if you will. But the top of the house is Brookfield Corporation, which is ticker BN. They're the mothership, if you will. And so they control everything. They own everything. That's the corporate top, if you will. A year or so ago, BN and BAM split. And so now you have the corporation, which holds all the assets. And then you have the BAM, which is the asset manager, which takes in funds from other entities like sovereign wealth funds and pension funds and things like that, and uses client money as well as Brookfield's money to go buy and different real assets around the world. So within that BAM umbrella, you have all the subsidiaries like the renewables and the infrastructure and the property and things like that. And so those are all subsidiaries of the main Brookfield. So you can invest in the company as BN, and you get a little piece of everything Brookfield does, or you can divide it out and just go for the asset manager, which collects fee revenue and things like that from all the different projects they have. Or you can be very specific and go to the subsidiaries like the insurance or the renewable energy or the infrastructure or the property business. Like, you can pick and choose which one you want to do. They all have great dividends and dividend histories. They're all committed to growing the dividend over time. That's one of the things I really like about Brookfield, is the dividend growth that they're able to provide. And so I've chosen to go the BAM route and do the asset manager, because as an income investor, I like the higher income right now, and BAM pays a higher dividend does. And they also intend to grow that dividend faster than BN. So that's why I chose that one. When it comes to the renewables, BEP was my very first renewable energy company that I ever bought, and this was years and years ago. I've held it for a long time. I just love the hydro electric that they have, the wind and the solar. I do believe that that's the future of energy, and so I wanted to be a part of that one. So I've held BEP for a very long time and plan on holding it pretty much forever. And then infrastructure, there's such a need for infrastructure around the globe, and local countries and cities just don't have the resources to build these multi-billion-dollar assets that they need to do, like bridges and toll roads and tunnels and things like that. So having someone like Brookfield, which has, honestly, unlimited resources when it comes to money, to be able to go and do these projects for these local communities and receive revenue from those, that's a trend that we're going to need to see for the next 50 years plus. And so Brookfield is the 800-pound gorilla, if you will. I was afraid my dog was going to as well. But they're the ones that are going to be there and have the resources to be able to provide all those infrastructure projects that the world is going to need. And so, again, I just want to be a part of that.
There's the train, by the way. We only had to wait about, what,
There you
6
go.
minutes for
Yep.
the first
I
train
can
to
hear
go
it
by.
rumbling a little bit, but not too bad. Yeah, so I mean, Brookfield's world.
Sorry to interrupt there. You were right on a roll with
No
Brookfield.
problem. Brookfield is around the globe. They have the contracts, they have the relationships, the partnerships around the world, and they have the resources. So people know that if they have a huge project need that's going to require billions of dollars, Brookfield's always on the top of the list, because one, they know they can get the money from them, and two, that they'll be a good partner. So I'll buy as much Brookfield as I can out there, to be honest.
Right, so that's definitely one of those positions that you're just gonna keep adding to and keep adding to
Absolutely.
and have no
Yep.
regrets.
So I've been adding heavily to BIP, the infrastructure partners, recently, as well as BAM, the asset manager itself. I've been adding to both of those pretty regularly.
Right. Right. Okay, let's move over to your country, the United States,
Okay.
and you mentioned before trying to consolidate some of those positions down, and you mentioned things like, ETFs and index funds, so I'm guessing, something probably SCHD then, and then looking at what's in SCHD and trying to figure out what you're doing with positions that are already in SCHD or others, I don't know, correct me if I'm wrong, or
Yeah, that's exactly.
I'll kind of throw it back to you and let you sort of.
Yeah, so that's exactly it. So SCHG is my number one holding. It's by far my largest position. I think last time I counted, it was something like 3,000 shares of SCHD or something like that. So it's definitely my priority. And everyone craps on SCHD over the last year or two because it hasn't done as well as the S&P 500 or something like that. And I mean, everything's cyclical right now. High tech, high growth names are where it is right now. But if you look back at 2022, tech crashed. So it comes in cycles, and SCHD did better than the S&P 500 back in 2022. So it comes and goes, but historically SCHD has performed amazingly, and it's provided a 3 to 3.5% dividend with a 12% dividend growth over the history of the fund. So when you use that and compare it to all the other individual names out there, it's very hard to find something that's been as consistent and provides the same growth level than something like SCHD. So anytime I look at an individual holding, I'm always comparing it back to things like SCHD to see if it's worth having that individual company or just put the money into SCHD and let it do its thing. And so that's what I've been doing the last couple of months, is really looking at my individual holdings and determining, Does it have the dividend? Does it have the dividend growth rate and the stability that I'm looking for compared to something like SDHD? One thing that I just sold, I think it was last week or the week before, was Duke Energy, DUK, which is a utility company here in the United States. I've held them for a long time, and they're very stable, as most utility companies would be. But if you look at their dividend and dividend growth, it just didn't compare. I think the 10-year dividend growth rate on DUK is like 1% or 2%. So that's not even keeping up with inflation, much less competing with something like SDHD, which is giving you 12 or 13% growth. So I always take a look and compare, and then
Right.
I decided to get rid of Duke because of that. It just wasn't growing where I needed it. And I'm still relatively on the younger side. I'm only 42, and so I still have 20 plus years before I realistically will be retired. And so I need something that's going to grow for me. And so I need to find something that, even if I find something that grows 5% a year, that's over double what Duke was. So I'm just, I'm
Right.
trying to really take a look at my individual holdings and make the determination whether it's the right fit for me.
Yeah, and you made a great point there about, like, beating inflation. We really saw it here in the last, 2 or 3 years, like, very high inflation rates for the first time in decades, really. But and then you just mentioned too, sort of your age and time horizon, another 20 years, we're probably gonna go through that cycle again at some point
Hmm.
down the road. So you wanna be not just keeping up with inflation, you wanna kinda be beating it as well, right?
Absolutely. Yeah. What's the point if you're losing purchasing power every year?
Yeah, great points, great points. So then other than SCHD and kinda doing this whole comparison of the individual stocks compared to that, what other ETFs and index funds are is also in your stockpile?
Yeah, absolutely. So I definitely have a lot of ETFs and closed-end funds, but for 2024, all my new money is going to one of four ETFs. So at the beginning of the year, I decide which funds I want to focus on, and I stick to that. So while my dividends that come in, I'll use that to buy individual companies or things like that. But any new money that I put into any funds, I focus on these four. So this year is SDHD, of course. Um, JEPQ, which is JEPQ, with the JP Morgan NASDAQ covered call ETF. Not sure if you have access to that in Canada or not. Um, I'm focused on what they call IDVO, which is an international dividend and option fund. And then the other one is RFI, which is a co-investor realty fund. So they invest in real estate companies or REITs. It's a closed-end fund. They pay a good distribution, and they've been around for, I think it's like 30-something years. And so those are the four funds that I'm focused on. So again, as I get money from my paycheck, new money comes in. Those are the only four purchases I'm making this year. I'm trying to build up those funds to a higher percentage allocation in my portfolio.
Right. Yeah, just to answer your question, we do have access to pretty well anything in the US, but we would have to buy it in New York or on the New York Stock Exchange or NASDAQ or whichever exchange they're on in
Hmm.
US dollars, so the exchange rate kills us. I know you and Anthony were talking about, the reciprocal tax, so we don't really have to rehash that.
Hmm.
I definitely, recommend going and listening to the episode with, Jeremy on the Newcomer Investor podcast because that's, very insightful as well. Um, I guess then sort of carrying on from that new money into those 4,
Hmm.
but you also mentioned that you're still pouring or not pouring, but, like, trying to buy as much Brookfield or whatever else. So
Yep.
is that just sort of the dividend money and not using new money, using the money that's coming in from other sources or your options income?
Yeah, exactly. So right now for my options income, I'm 100% focused on reinvesting those into more options. But my dividend income, I am using to, allocate to individual names, things like that. So my dividend income is quite large now. And so, I get, a few $1,000s every month and that I can reallocate. And so I use that money to build up my individual holdings.
It definitely is nice when that snowball starts getting bigger, right? And you can actually start allocating funds on a monthly basis,
Absolutely.
to to continually make the snowball bigger.
Exactly. That's one of the best things about, dividend investing is that snowball, and your dividends create more dividends, which create more dividends, and it just keeps on going. And before you know it, you have amount of income coming in to replace your job, and that's really the whole point.
That is the entire goal, right? Just get that passive income to the point where work becomes optional.
Exactly. So what have you been looking at recently on your side of things?
So as I already mentioned, Bell Canada, I've just been kind of plugging along every other week on payday, or when the dividends roll in, just kind of add a few more shares. Same, I've been adding more shares to Bank of Nova Scotia, and well, we know what that's about. Can you see that?
um, oh yes, 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 yeah, might as
Turn
well.
that cash register
Yep,
around.
yep, yep.
So, basically, I pay my cell phone bill to Bell. I pay my mortgage to Scotiabank. I have a CIBC Visa, so actually just recently opened a position in CIBC in my RRSP, which is the retirement account here in Canada.
Mhm,
Most of my holdings are within my TFSA. I have been very slowly trying to add actually to Toronto Dominion as well. Hydro One is the name of the like
mhm,
electricity provider here in Ontario, and they supply electricity to at least 98%. Basically, if you live in Ontario, you pay your hydro bill or your electric bill to Hydro One. So that just makes sense. They're pretty much a monopoly, right? And I think they're probably one of my lowest dividend yields, but it's sort of that similar idea of turn that cash register around. I pay my bill to them, so why wouldn't I get them to pay me a little bit of it back? So those are kind of the ones in the last year or so that I've been trying to increase my positions in. And then kind of going back to similar to what you said or what you had done is just the other ones, just kind of leave them be.
mhm.
As long as those dividends keep coming in, I'm happy. I did get, I was very, or still am very overexposed in REITs. And so I got hit really hard with REITs the last year and a
Mhm.
half with, again, going back to the inflation and then interest rates and REITs got hit really hard with the interest rates. So I suffered way too many dividend cuts in the last year. It's enough to make you cry. I almost did cry a couple times, but
Yeah, and then
um,
that's really
but
one.
kind of overall, the snowball is still growing, right? So
Absolutely. Yeah, I mean, as a dividend investor, you're gonna have dividend cuts. It's just part of the nature of what we're doing here. But that is another reason why I'm starting to focus more on funds than individual companies, because if you do get a dividend cut and you're holding an ETF and, one of those cuts their dividend, it's not gonna really affect you as much as if you held that individual company and you got a 50% dividend cut or something like that. So that's another reason why I'm focusing more
right.
on the ETF side of things. I had a question for you. Do you have any semiconductor companies in your portfolio? Um, like,
No,
like,
I don't.
yeah. So I've been looking recently to see if I can add to that industry. So right now I have AVGO, which is Broadcom. I have ASML, which is a European manufacturer of the equipment that makes the semiconductor chips, and I also have a very small position in NVIDIA. But I'm been looking to see if there's something else out there, like an ETF or something like that, that I can invest in for the semiconductors. Because, honestly, in the next 20, 30 years, semiconductors are going to be a huge part of the growth in our countries and the global economy. So I'm trying to identify
Yeah.
something like that. And I might have missed the boat already, but I still think there's decades more to come. So I've been looking for different funds that way. So I'm, just curious if anyone else had anything out there.
Yeah, please in the comments below, help us out here. So, interestingly enough, just a few days ago, might have even just been yesterday, I was looking at the 5-year chart of Nvidia, and I was like, "Oh, you could have got this at like $38 5 years ago, 2019 or something like
Mhm.
that, and
Mhm.
it's now
Mhm.
trading at 600 or 680 or something." It was like,
Yeah,
well, some smart people made a lot of money that bought in 2019.
yeah, hopefully people held on to it. There was definitely a roller coaster ride in 2022. Hopefully a lot of people weren't scared out of it at that point. But yeah, it's been amazing. I've held it for maybe 6 months or so at this point. I got in really late and I'm still up like 40 something percent on it. So it's been on an incredible run. It's quite ridiculous, to be honest. They have earnings this week, so we'll see how the market reacts. It could be a very big day or it could be a really bad day. So we'll have to wait and see. But I have like I don't know, 3 shares of Nvidia. Like, I really don't have that much. It's a tiny portion of my portfolio. In retrospect, I wish I would have put thousands of dollars in, but it's the way it is. So
Yeah, in 2019, right?
exactly, exactly.
Or 2017 or whenever.
Yeah, I might be fully retired at this point if I would have done that. So yeah, yeah,
It's always easy, that hindsight is 2020. It's always easy to look back and say, "Oh, I should have bought this company or I should have sold that company." That's
yep.
that's the easy part, but, none of us have that crystal ball to see exactly what's happening in the future. Although I do tend to agree with you over the next, uh, 15, 20 years and more, there's just gonna be more and more semiconductors needed. There's more computers, there's more smartphones, there's more electric cars, everything.
Mhm.
Even going, I've talked with other people about, like, the heavy equipment industry, Caterpillar and John Deere. Like, you get into a brand new cab of a new John Deere tractor, like a farm tractor, or a new Caterpillar excavator, and these things are like spaceships in there,
Mhm.
right?
Yeah,
So,
they can pretty much run
there's
themselves a lot
semiconductor
of times.
days.
Absolutely. And
You probably
with
could.
AI being
They're getting
built
to the
out,
point where you can program them, no doubt.
I think so. And with AI keep on being developed, they're going to need more and more computing power, and so that's where semiconductors come in. So I definitely think it's a global trend. I'm just trying to decide if it's the right time to buy, or should I wait for another downturn, or just bite the bullet and dollar cost average over time. So that's the thing with the investors. You're always weighing all these possibilities, and that's the hard part, is coming up with a final decision. And then another side of that is, do I want to add another holding to my portfolio? I already have so many. Do I really want to keep track of something else? So it's just all this back and forth that we have to go through as investors to determine the right thing. So yeah, it's always a struggle for sure.
Well, and I think you made a great point there. If anyone out there knows of an ETF that is focused into those semiconductors and probably some tech stocks or whatever else might be in that ETF, that would, again, you might be adding one more position, but getting 50 more companies in
Yep.
that position, or
Yeah,
whatever the number
exactly. And
might
then you
be,
don't have
right?
to be as concerned with which one is going to be the major player going forward, because you have a little piece of all of them. So that's definitely a good approach. Kind of going back to your comment earlier, is in hindsight it's always easy to know what to do, but it also goes into the fact of how you will react when there is a downturn. Everyone's always saying that, oh, I'll definitely be able to hold
Right.
on to everything. I'll actually add more money when there's a major downturn. But in reality, it's hard during those times. That's when you're the most scared. Like, it's hard to have the fortitude to add more money to your holdings when
Yeah.
they went down 50% or 60% or whatever it happens to be. The whole economy seems to be going under. And that's the best time to buy, of course. But when you're in the middle of it, that's a very hard thing to do. March of 2020, back in 2008 and 2009, when it felt like the whole world was going to end. The dot-com bubble of the early 2000s, those were obviously, in retrospect, the best times ever to buy. But in the middle of it, you were terrified. You were scared. All your friends were losing their jobs. People were losing their
Yeah.
houses. So, like, you have to really think hard as an investor of how you're actually going to truly react. And maybe you won't even know until you go through it. A lot of people that are investing now have only been here during the 2020 crash, and then the dip that we had in 2022, but they haven't seen a major extended bear market like we did in 2008 and 2009, things like that. So just get yourself ready mentally. Think about what you would do and put some safeguards in
Yeah.
place, because it's hard. It's really hard to keep going.
So a prime example of that, I'm not sure, if you're into cryptocurrencies much or not, but Bitcoin is an absolutely perfect example of that hindsight
Hmm.
being, "Oh, I should have bought 1,000 Bitcoin back in 2011 or
Yep.
12 at a
Yep.
dollar a piece," or whatever the number was, right? But then Bitcoin is so volatile. Well, like, would you have held that in when I think it was 2017 or 18 had a major
Hmm.
downturn? And then, just this past year or 2 year, well, like, year and a half, it had another major downturn, and now it's on the rise back up. And, everybody loves Bitcoin when it's over 50 grand, but nobody was touching it with a stick when it was below 20, right? So
Absolutely.
I think Bitcoin is a prime example of what you just said, right?
Yep. Yeah, you might think it's the next best thing, but you also have to stomach those years of volatility. I mean, back in the early 2000s, Amazon went down to a few dollars a share. Like, it lost 90% of its value. we all think Amazon is this great company today, but back then there was a real possibility that it was going to go out of business. And so like it's really hard
Right.
to stick with your names and ride it out over the long term. But of course, you'll be rewarded if you're able to.
Yeah. Interesting. I'm gonna bring up some of your social
Sure.
media. First, your website, which of course all these links will be in the description below. And this is just dividendstockpile.com. Anything you want to kind of say about your website? I guess it's mostly a blog type website.
It is a blog, yeah. So it's where I write articles every so often. Definitely been struggling keeping up with it lately. Life has just gotten in the way. But yeah, so I started this blog a few years back as kind of a way to put my thoughts and ideas out there. So I've been blogging for a couple of years now. Focus on everything from individual company analysis to the mindset you need to have as an investor. I did a couple book reviews in there. It's also where I link all my current holdings to. So on the top of the page, there's a dividend portfolio link. Um,
Yeah, right
so
here.
you can see all my holdings, and I update that at least quarterly. Have all my videos that are on my YouTube channel show up on this page as well. So it's just kind of like my home base, if you will, of my investing. So yeah, I really appreciate you showing this. Would love everyone to take a look, read through some articles, subscribe to the notifications if you're interested. Definitely, I feel like there's some good stuff out there.
Oh,
So I appreciate that.
there, yeah, there we go. Sorry, my internet was just taking a while to load the page, but yeah, all of your holdings here in the dividend portfolio.
Yep. Yeah.
And then I actually also saw up here your options account, and obviously lots of pages to click around here. I won't spend too long on this because I have had people say in the past, just link the website. We can go and read it ourselves. You don't have to read us the whole thing. I'm like, fair enough, fair enough.
Yeah, I appreciate that. Yeah, so a couple years ago, I was trying to figure out because I'm a part of a lot of the Facebook groups and on X and stuff like that, and it's one thing to share there, but you really can't go into the in depth that you would be able to on a blog. So I started that a couple years ago. It's done pretty well. I'm very happy with where I'm at on that one. But then about 6 months ago, I started my YouTube channel because a lot of people were saying, "Hey,
Yeah, I just switched over here to YouTube,
we love your videos."
and you've done great. You're over 1,000 subscribers already.
Thank you, I appreciate that. Yeah.
And honestly, I thought I was subscribed, so just let me do this
Well,
and make sure everybody can see how easy that is. All you got to do is click
I'm
subscribe.
sure you are, but when you log on your computer, sometimes it's a different profile. But yeah, so people were saying, we love your blog, but sometimes I don't have the time or ability to read. I'd love to hear it in video form. So for the longest time, I was like, no, I really don't have time for this. I really don't know what I would talk about. But 6 months ago, I finally got convinced to do it. So 6 or 7 months ago now. Um, I
Right,
was terrified. I didn't know what I was doing. So I just put it out there, and thankfully, it's a great community both on Facebook and X and YouTube. They're able to get some traction underway, and yeah, so far so good. So I'm very pleased with where we are right now. To your point, I just hit 1,000 subscribers, but I'm still looking for all those watch hours. So if anyone has any recommendations, or feel feel free to
right.
watch a couple videos for me. I appreciate that.
No, honestly, that is amazing. That is really incredible growth on YouTube just over 6 months, 7 months ago, I guess, is your first one here, it says. And
Yeah.
to already have over 1,000 subscribers on just 26 videos, that is really impressive growth. That does mean, people do like what the content that you're putting out there. So, yeah, highly recommend. Again, this link will be in the description, so anybody that wants to check out, uh, at Dividend Stockpile on YouTube, definitely head over there and give Jeremy a subscribe again. It's really easy. Just click that button right there. It's so simple, right?
Yeah, I really appreciate it. Yeah, and I love all your videos as well. Love listening to all of the interviews you have. It's great to see the community all coming together to talk about this stuff because prior to YouTube and Twitter and things like that, we didn't have anyone to talk to. I know no one in my
Right.
personal life likes talking about this stuff, so it's great to have this community out there. And that's one thing that your channel has really shown is that there are so many different voices in the community, so many different ways of doing it. So no matter what your background is, what your approach is, we can all learn something from each other. So it's been great following you as well.
Yeah, thank you. I appreciate that, and it has been an absolute blast to talk to so many people like yourself and so many others with, so many different stories and different paths and different journeys. And yeah, I obviously I've learned so much from everyone, and it's just been absolutely amazing. Just quickly here also is your Twitter/X profile, which I will also put in the description. Very easy, just at Div Stockpile. Be sure to give Jeremy a follow on X as well.
I really appreciate it, Dave. I love connecting with people, so definitely feel free to reach out on X. Send me a DM if you want to chat more. I'm happy to set up some time to chat if it's something you want to talk through.
Yeah, awesome. Awesome. Wow. Another 50 minutes just flies by talking about what we love to talk about. Before we wrap it up, anything else you want to kind of touch on that maybe we missed?
Yeah, just to keep investing. A lot of people say that the market's at too high right now, but at the end of the day, you never know. So just keep adding to your stockpile every single week, every single month as you have money. Make sure you have the savings uh, set aside for the emergencies, but otherwise, just keep investing. 5 years from now, 10 years from now, the prices we're paying today will seem like nothing. And in the meantime, you've been collecting
That's the exact point I was about to
yeah,
make.
those dividends will continue to stockpile over time and grow and compound, and you'll be amazed where you're at 10 years from now. Don't give up on it. That's the most important thing. I've been investing for 25 years, and it is amazing how it's grown over the years. So just keep going at it.
Yeah. I think that's a great point. Like the prices look high right now, but like you just mentioned, in 10 years, the prices we're paying today, you're going to look like a steal. So
Yep.
don't necessarily compare the price of in February or March 2024 to the prices that they were in 2 years ago in 2022 when the market was down, right?
Mhm.
Like think about where the market's going to be in 2034, 10 years from now, or 2040, right? So
Exactly.
that's the
Exactly.
long-term mindset you definitely need to take in the dividend investing.
Absolutely. You have to. Dividend investing is a lot of time or a lot of money or both. So, stick with it. Make sure you're making it a priority, and your future self will thank you.
Yeah, that's another word. And just get on base, just get started. That's a very key one too, right? Whether you're like you said 25 years ago, so you what were you 18 years
Hmm.
old when you
Yep.
started? Yes. Which is obviously the best time to start, right? When you're 18, 19, 20 years old and you have that 30 to 40 year time horizon, but even if you don't start until you're 30 or 35 or 40, the whole idea is just get started. Even 45 or 50, just get started. Get
Absolutely.
something set aside um, for the future. So,
Absolutely. Yep. It's so important for your
before
future.
we wrap up, I do just want to say one more time to Erica, Millionaire Mentorship, for sponsoring this episode of the Passive Income Podcast. I also want to give a shout out to buyinvestingshirts.com. Again, receive a free Passive Income Posse. Turn that cash register around coffee mug with any purchase over 100 Canadian dollars. So that's a steal for you guys in America before taxes and shipping at buyinvestingshirts.com. Use code word posse for a 5% discount. That link is also in the description. So lots of links in the description to check out. Jeremy, thank you so much for coming on and spending time with me here on the Passive Income Podcast. I truly appreciate you and your time.
Awesome. Same to you, Dave. Thanks for having me. It was a lot of fun. Look forward to talking in the future.
Still here, well over 50 minutes later. Please be sure to hit like and subscribe.